Howdy, everyone. This is Darius Dale, founder and CEO of 42 Macro. I have the great pleasure of being joined today by Jurrien Timmer, Director of Global Macro Fidelity. How you doing, Jurrien?
I'm well, Darius. It's great to see you.
It's great to see you as well. So for those of you who don't know, I guess most don't know, but Jurrien's one of the hardest meetings on Wall Street. I certainly remember many a days going from meeting to meeting in Boston, and that last meeting at 245 Summer Street. If you're not ready for that meeting, it's going to be quite tough. So I appreciate all the difficult questions over the years, man. You've certainly been a closet mentor of mine in terms of forcing me to go back to the rabbit hole and improve upon my analysis. So thank you for that.
You're welcome.
Yeah, no, you're a mentor to many, my friend. So obviously there's a lot to talk about. This is probably one of the most uncertain times of my career, uncertain times of many investors' career with respect to projecting the forward outlook for something like growth, for inflation, the reaction function of both of those dynamics. You've been doing a lot of excellent work on the asset allocation space of late with respect to inflation specifically. So talk to me about some of the key findings you've been discussing with investors as it relates to asset allocation in a more inflationary regime.
Yeah, it is certainly a very pivotal time. Obviously it originally started with the financial crisis that ushered in a new way of conducting monetary policy, although it wasn't really new because the Fed did what it did during the GFC back in the 1940s. And then we had a period of quiet, very, very low interest rates, very healthy risk premia in the markets. And then, of course, COVID happened, and that ushered in this massive double-barreled bazooka of fiscal and monetary policy responses, which I think was very good at the time because it helped build a bridge to the other side of the pandemic, and it really cut off the left tail of the market cycle. But now we're seeing the other side of that. Like you look at the housing market, there was no left tail in the housing market a year and a half ago. So now we have prices booming off of much higher levels. And same thing with the stock market. We did obviously see a pretty sizable crash of 35% over 5 weeks. But again, the Fed and the Treasury, the policymakers, were able to cut that left tail off. But again, it has kind of created a bunch of different cycle phases, and I know you've looked at the phases of the business cycle, for a very long time, but we're kind of in like different pieces now, right? So we were obviously in a recession or even a short-lived depression, kind of like a natural disaster analog. Then we went into early cycle recovery. Then we're now in mid-cycle, right? Earnings growth is kind of pulling the weight of the market now, whereas a year ago it was just valuations. But we're also seeing late cycle pressures. We have inflation. We have the Fed now, starting to taper and on its way to starting to raise rates, second half of next year. And of course, the big question is whether this inflation will be transitory, as the Fed thinks, and actually as the market seems to think as well. If you believe the TIPS break-evens, right? I mean, the five-year forward is at 2.2%, which says, we don't see a problem here. But if inflation were to become more structural, and we are seeing signs of it in the labor market, of course, in the housing market, those are two big drivers of core inflation. The question is, what does that do to the 60-40 paradigm, right? Because the 60-40 paradigm is what our entire industry is basically built on. It has worked. The question is, what does that do to the 60-40 paradigm, right? Because the 60-40 paradigm is what our entire industry is basically built on. It has worked incredibly well for the past 2 decades. But, the 40 side, so the 60 side obviously is the equity side, the 40 is the bonds. And during normal times, investors would get paid to be in the 40 because you would get a yield, a real yield, not only a nominal yield, but a real yield. And on top of that, you would get kind of the diversification aspects of being in a negatively correlated asset class, so that when the stock market does go down, which it does 40% of the time, people don't quite realize that it helps us sleep better at night and not hit that panic button, which is often one of the worst things we can do, right? Because then you're selling the lows and you've lost out. Not only have you locked in lows at that point, but you lose out of the compounding, power of the stock market. So the 40 helps us just kind of weather that storm. But then in recent years, of course, there is no more robust nominal yield to be had. The 10 years at 1.5, 1.6. So we're no longer getting paid to play. Now we have to pay to get insurance. And if inflation becomes more structural, which is not a prediction, but if it goes from, let's say, 2% to 3 or 3.5 or even 4, those long-term government bonds are going to lock in a negative real return of several percent. And so what does that do to the 60-40? Does the 40 still work? And the only way it would in that scenario is if it still creates that negative correlation to equities. But history shows that when inflation goes north of its average for a sustained period of time, that the correlation can often flip from negative to positive. And if that happens, there's literally no reason to own bonds because you're not getting the yield, you're getting a negative real return, and you're not getting the diversification anymore.
That's an outstanding point you made there. With respect to that correlation, are there certain triggers, but going back to the research you're citing, are there certain triggers that catalyze that correlation from breaking down? You said, going above sustained inflation for an extended period of time, going above the average of inflation for an extended period of time. Are we close to one of those triggers now? And if not, then could give us some insights on kind of how to calculate that and how to give us a roadmap to guide us over the next few years.
It depends on which data you believe, right? So obviously we know the CPI is running north of 5, which is a significant amount of inflation. But we also know that, the CPI that we look at, the inflation rate, is a rate of change, right? And so you get base effects. And obviously coming off of a very depressed level a year and a half ago, it is mathematically, certain that it is transitory from a mathematical point of view. But and we won't know the answer for a while on whether it is structural, because what happens is you have the index level of the CPI and you have the rate of change. So the rate of change went from low to high. The index level is obviously going up because one goes with the other. And then what will need to happen is once the bottlenecks become resolved, that rate of change starts to come down. And then we have to see where it settles out. And a similar thing happened during the 60s, right? Inflation was very, very low, 1-2%. We got a little wave, then it went back down, but it went to a higher low, just applying technical analysis on the CPI here. And then it did another wave, very modest, 3%. Then it went back, but again, a higher low. And then all of a sudden we're in the late 60s and it's like, the CPI is printing 4 or 5% and then going down to only 3% and then going to 7%, et cetera. So, but the point is that takes a long time to demonstrate or to manifest, right? You need multiple cycles to really know how sticky or structural inflation is. And what we know is that the Fed is, of course, saying it's transitory. It's not saying it's short-lived. I think, Chairman Powell made an important distinction that he wasn't saying it's going to go away immediately. It just means that they are non-permanent forces, which I guess is true, right? I mean, supply chain bottlenecks are not going to be permanent because you have trillion-dollar companies that are going to work very hard to resolve those supply chain bottlenecks. But that doesn't mean that inflation can't become structural. So, we look at the TIPS market, like I mentioned before, 2.2%. The market sees no problem unless the market is not really a good pricing signal anymore because, the Fed owns about 29% of the TIPS
right.
market. So that's another question. It's like, do we even have that signal anymore in the bond market? So it's a question without an answer. But when I look at the labor market, I look at the housing market, I could see where structural forces would be there to push inflation higher. But then on the other hand, we look at technological innovation, which of course is highly deflationary. We look at demographics, which is deflationary because we're on the baby bust side of the demographic wave. And so it's just a question of which one will win out at the end.
You're absolutely right. I think you more elegantly summarize my long-term view on inflation with respect to the pandemic and its impact on that time series, I've been in the camp that, look, right, and just because of all the math and the base effects and the impulses, you're going to see inflation decelerate pretty markedly throughout 2022. I think that's almost a mathematical certainty. And quite frankly, if you're arguing that it's not a mathematical certainty, you need to go back to business school. The real question on inflation is, what does the stationary mean? Has that transposed itself higher with respect to the oscillations that we see around those means? Clearly, the stationary mean for inflation has been ratcheting itself lower over the past few decades. Have we hit a bottom in that statistic? And if so, what's driving an impulse higher? I happen to think that we are driving an impulse higher, but I'm curious on your thoughts on that.
I mean, I'm no inflation expert, but I do look at a lot of history. And I do know that when you look at the inflation rate over time, and not the year over year, but I look at longer term waves, like the 5-year CAGR of the CPI, there's a pretty close correlation between that series and the long-term growth rate in the labor force, for instance, right? So during the 70s, which is everyone's favorite example of inflation, which is really a very unique moment in time that has almost never been replicated. So maybe the 70s is not the best analog to use, but we have the 40s, which actually was a good analog because that was World War II. There were supply chain bottlenecks. There was financial repression from the Fed. And then we had a few mini waves, late 80s, early 90s, the 2003 to 2008 period. I mean, we don't think of that as an inflation period, but in 2008, the CPI was printing north of 5%. And we had a massive commodity bull market, as you probably well remember, with oil going to 150. So we've had other regimes that are not like the 70s, but were still significant. But for me, the long-term gauge remains demographics. I think demographics are very, very important. And when you look at like a 10-year CAGR of the labor force, it was rising during the 70s as inflation was rising, and then it peaked in the early 80s, and it has been coming down ever since, right in line with the term premium, with nominal yields. And the labor force is barely growing. It's growing at maybe 0.5%. And to me, that is a kind of a good example of demographics and how just fewer people in the labor force growing less robustly is all things being equal a deflationary force, along with technology, along with globalization, which is now a little bit in reverse, of course. But those three drivers, to me, explain how we've had this disinflationary super cycle over the past 10, 15 years, and why the Fed was chronically unable to get up to 2% inflation. Now it may be on the other side of that, where it's going to not be able to push it down to 2%. But my sense is, and we can talk about this a little further, is that the Fed doesn't really have a choice. The Fed can't really say anything other than inflation is transitory, because what is it going to do about it, right? When Volcker killed the inflation beast in the late 70s, debt to GDP was 30%. It's like 140% now. There's no way that Jay Powell can turn out like Paul Volcker, because it would kill the economy. The economy is too levered to low rates. And so the Fed has no choice but to say that it's transitory, and the markets ultimately will determine, what the Fed can do. I mean, it sounds cynical, but the economy has become so financialized that ultimately the markets, as a manifestation of financial conditions, will set the stage.
Indeed. And on back to that point on Jay Powell and Paul Volcker. Paul Volcker killed inflation. I think he was like 6'8" and didn't really need a security detail for all the people picketing outside of the Equities building. Jay Powell's a little smaller than that.
And he had a big cigar.
Yeah, exactly. I think if he tried to kill the economy like that, he'd need a little bit more detail.
He had a big cigar, and he had those great chunky 1970s glasses.
What a legend.
It was like he really perfected the look.
He did. And so I think you brought up a lot of great points in terms of the drivers of inflation long term. Because obviously, in the shorter cycles, things like commodity prices, things like base effects have an outsized influence on CPI and PPI statistics. When you talk about what's the stationary mean of those time series over a longer term time horizon, you do have to unpack the sort of balance the balance sheet, if you will, with respect to some of the drivers of disinflation, some of the drivers of inflation. And so I put together kind of all the things that, some of the things you've mentioned, and including a few others, that would seem to suggest that on balance, the direction of travel for something like a 5-year CAGR on CPI should be meaningfully higher over the intermediate to long term. So if you think about balance sheet analysis, assets minus liabilities equals equity, I think the equity very narrowly tilts towards a rising inflation regime. And so you mentioned globalization. I want to think how I calculate that as imports of goods and services as a percentage of GDP as a proxy. That's at 13%. That's down from 15% in 2019. So that's a check towards inflation. On the other side of that, you have technology. And the way I sort of calculate that is the NASDAQ 100 market cap as a ratio to the Russell 3000 is the broader measure of U.S. equities. That's at 38%. That's up from 15% in 2019. So you can kind of make that a wash. Money supply, that's at 21 trillion, up from 15 trillion in 2019. Money velocity is at 1.1. That's down from 1.4 in 2019. So that's kind of a wash. You got household wealth. Everyone talks about excess savings and the ability for that to perpetuate consumer demand. Looking at household net worth, that's at 142 trillion. That's up from 117 trillion in 2019. But on the other side of that, you have rising wealth inequality. So the top 10% of households by net worth own 70% of the assets, 70% of the net worth, and that's up from 69.5 in 2019. The bottom 50 is down there at 2%. You got household income. Employment cost index just hit a new cycle high. It's the highest level we've seen since 2004, 3.7% year over year. That's up from 2.7% in 2019. But then you got income inequality. The Gini coefficient has actually moved up since the start of the pandemic, up a 100th of a point on that statistics. And then lastly, obviously, you got public debt, public deficits, skyrocketing the deficit to GDPs at minus 12%. Fiscal balance as a percentage of GDP, or the federal debt as a percentage of GDP, as that's at 126%. Both of those are markedly higher than they were prior to the pandemic. But then in terms of, what that's actually paying for, the household propensity to consume is actually, lower. The employment to population ratio is at 58.7% now. That's down from 61% in 2019. And then on the other side of the public debt, you have a population that is incrementally willing to suffer through financial repression as a function of that. So in demographics, look at the percentage of people who are 65 plus. That's at 57 million now. That's up from 55 million in 2019. So those 12 things, 6 of them are positive in terms of perpetuating higher inflation. 6 of them should perpetuate disinflation relative to the start of the pandemic. And so the only thing that's changed, and this is why I say the balance of risk tilts higher to inflation, although it's not as obvious, I think, as a lot of people on Twitter and a lot of investors want to believe it is, the balance of risk, it tilts towards inflation because of the Fed's reaction function, just as you said. They're trying to solve big structural problems like wealth inequality and racism in the employment market with balance sheet policy. And that's clearly not going to be a successful solution, but they're going to try with their maximum inclusive employment mandate. And they're also, obviously, they've adopted an average inflation targeting mandate to support that desire. I don't have any bone. I don't think they're going to fix racism in America with the Fed's balance sheet, but I think they're going to try. And I want to know your thoughts on that as it relates to, can that alone, in the context of everything I just said, get you to a much higher level of inflation on a sustained basis? I'm talking 3, 4, 5, 6, 7 years from now.
I think so. I look a lot at historical analogs. It's kind of what I do. And one of them, when we were in the lockdown in the depths of the pandemic, a year and a half ago, I mean, we're still kind of in the depths of it, but in terms of the market cycle, a lot of people went to the 1930s as like, oh, this is like 1929. And I'm like, no, it's not, because the problem with the 30s was a lack of policy response, right? Like the Hoover administration let the banks fill. They're like, yeah, they don't run a good business, let them fill. So you had a run on thousands of banks. And, Benjamin Strong, who was at the Fed in 1928, he kind of ran the Fed very single-handedly. He died, and then the Fed was kind of left rudderless without the tools. So the Great Depression was never going to be a good example of the crash we had, a year and a half ago, because the policy response this time around is so much faster, or was so much faster and so much bigger. And again, like I said before, it was double barreled, right? It was fiscal and monetary. That rarely happens, right? Often, like we have an independent central bank, at least on paper. And so oftentimes when the fiscal pendulum is swinging this way, the monetary pendulum is swinging the other way. Remember, after the financial crisis, the Fed was doing QE, and at the same time, the Tea Party became in power, and we actually had fiscal austerity. So often the two are moving in different directions. But during COVID, it was double-barreled, and that brings me back to the 1940s as really, I think, the best and almost only analog of seeing that coordinated policy response. And, the Fed will say it's not necessarily coordinated, and that's fine. I'm not going to argue with that. But fiscal and monetary, so back then, we obviously the U.S. went into World War II in 1942. We had like price controls. We had obviously the whole economy was being mobilized. A massive fiscal impulse. The debt to GDP tripled, and the Fed, which was not yet independent at the time, that happened in 1951, was tasked with capping bond yields. Right, T-bills at 3/8. Long bonds at 2.5. The policy rate stayed at around 1.5%, even though inflation was 5-6% during the 1940s. And the Fed increased its balance sheet by tenfold to absorb the increase in debt. So it was kind of doing yield curve control. So if yields went too high, it would buy the bonds. And so that's a long way of answering your question. But that was an era where the Fed was concerned with much more than just price stability, right? Like we would think of of a central bank, like in the Bank of England, the European Central Bank. All they care about is price stability and nothing else. The Fed, of course, has a dual mandate. It has full employment also as a mandate, and then you can argue there's more mandates. There's the financial condition stability, the stock market, credit spreads, bond yields. That's the financial economy, which is a much more real-time indicator than the real economy, right? Like if the Fed were to conduct policy on the basis of the CPI print on the unemployment report, it would always be behind the curve, right? So it has to look at the financial economy through financial conditions. And now there's kind of this ESG, DEI, social justice lens, which is also relatively new, for the Fed. And so I do liken the Fed today to more like what it was in the 40s. Not that there was a social justice lens then, but just that it was tasked with more than just managing policy to achieve price stability. And so I think the financial repression that we saw then, meaning the Fed forced bond yields to stay below the inflation rate, and which is, obviously a sort of a tax on bondholders. I think we're in that kind of scenario now and are probably likely going to remain there. And so I do think that forward real returns on bonds are likely going to remain negative, and that's going to be one of the ways that the Fed and the Treasury or the administration is trying to right the ship, not only economically but also socially.
Yeah, no, I completely agree with you in terms of their willingness to pursue that path, because obviously the only other solution is default, and that's clearly not gonna cut it from the perspective of any politician who likes to stay in office. You kind of said something that was fairly loaded. You said sort of. You kind of believe that we're already there with respect to a pseudo yield curve control policy. And I would tend to take the other side of that in the sense that we probably need to see somewhat more of a slowdown for the Fed to officially adopt that sort of view. So walk me through sort of how you get to why you're there already. And if you're not there, just clarify that.
Yeah, so the Fed is obviously not doing yield curve control now, but it is buying $120 billion a month in paper, and that's obviously going to end in the coming weeks. So the Fed is repressing rates downward, and we see this, right? If you look at historically, if you run a scatter plot of TIPS break-evens and nominal yields, there's obviously a very clear linear relationship, as you would expect, right? If inflation expectations go up, there's a term premium, yields go up with it. Right now, the nominal yield is about, or at least a few months ago at the lows when it was about 120 or so on the 10-year, that yield was about a percentage point lower than where it normally would be based on inflation expectations of about 2.5%. That, to me, is completely attributed to the Fed's heavy hand in the market through asset purchases. So it's not a curve control, but it's just the heavy hand weighing down on the market. And then, of course, there was a good timing on top of that where the 1.9 trillion in fiscal stimulus back in March was essentially funded by the Treasury running down its cash balance at the Fed, the TGA account, the Treasury General Account, rather than having to issue new debt. And so you had a very favorable supply-demand composition of the Treasury issuing less bonds while the Fed continues to buy them. But where I think the financial repression could continue to play out is that right now yields are kind of moving up, certainly in the belly of the curve, but on the 10-year as well. We're at 1.6 or so. We were at 1.7 about a week ago. I would imagine we could easily go to 2%. And I don't think that's going to derail the economy or the stock market, depending on whether that move higher comes on the back of higher inflation expectations or higher real yields, right? Remember the taper tantrum in 13, that was a real yield move. There was no change in inflation expectations. And so big shocks in real yields can really affect the markets and the economy. So it really depends on what the composition is of any further rate rises. But if there were to say a large backup in rates and it was based on real yields going up, I think the market would have an issue with that, and therefore the Fed would have an issue with that as well, because the Fed follows financial conditions as a proxy for the financial economy, which is a more real-time version of the real economy, right? I hope that makes sense. And so at that point, if rates got unanchored north of 2, I could see the Fed kind of stepping back in and saying, well, we're not doing QE, but we're going to do some kind of yield curve control where they're buying fewer short bonds and more long bonds or something like that. And it actually brings me back to another totally disparate example from the 1940s, and that's Japan today. Totally different backgrounds, different cultures, different economies. One is deflationary, one was inflationary. The 40s in the U.S. was inflationary. But the Bank of Japan completely owns, or not completely owns, but it owns half of the JGBs in Japan. So the Japanese central bank has completely tamed the Japanese bond market. It buys half the new flow. It owns half of the stock of debt. And the volatility of long-term Japanese bonds is 3, whereas the volatility of long-term U.S. bonds is 11. And so that market is really not a market anymore. And I'm not saying that we're going in exactly to that point, but I do think we're going to go in that direction. And like the 40s, where the Fed was really a very large influence on the bond market, and the Bank of Japan is now a large influence on the Japanese bond market, it wouldn't shock me at all if in the next 5-10 years or so, the Fed will do the same thing. And you can kind of see why, right? If we're going to have a debt to GDP 5-10 years from now of 200%, somebody better be in there, keeping bond yields low, because that's going to be the only way to keep that sustainable.
Yeah, no, you're absolutely right. I shudder to think about that, the path of progression to get there, because very clearly there's some very tough decisions that have to be made on the inflation front, on the stock market front, on the capital market front broadly. So it's it's very clear that that's sort of where we have to go. And maybe MMT is a solution for all that. And I caveat the word solution because I don't know that inflation is ever a solution, but it certainly might be the better.
Yeah. Well, and you don't even need outright MMT. I mean, in a way, what we're seeing is, MMT means the Fed basically has the power to spend. And then I think you get into all kinds of, slippery slopes of, you have the Fed kind of also writing checks, but you don't even really need that. What's important is that we have this coordinated or uncoordinated, but fiscal and monetary kind of partnership. And it's interesting that that of course the Treasury Secretary is Janet Yellen, former Fed chair. And so all you need is so let me back up. After the financial crisis, right, the Fed did all that QE, similar amounts as it is today, although off of a lower balance sheet. But that money got stuck in the banking system as excess reserves, and so they were never spent. This time around, it's still excess reserves in the banking system, but now you have the fiscal side on top of it. So now that money is spent. That's why over the past year, try getting an airplane ticket at a reasonable price or renting a car. Like you're seeing that fiscal impulse, and the Fed's in the background, kind of keeping things, under control. And so to me, that is probably going to be the paradigm. And I think from a political point of view, you mentioned, social justice earlier, but also wealth inequality. That I think might be a way for the government, certainly in its current position or its current political power, to try to swing the pendulum from capital more towards labor. And I think that is obviously one way to address wealth inequality, and taxes are part of that and all that stuff. But so there are a lot of very large balls in the air here where that can continue to play out for a number of years to come.
Yeah, no, you're absolutely right. In terms of, looking out over the next year or so, one of the things you said, so the Fed kind of has to stay on board with this policy, with this, with this setup, with this new construct that we've amalgamated or cobbled together in the pandemic. It seems as if, and it seems is probably the wrong word, it very much appears as if they're on the path towards untethering themselves to this new construct. We obviously just saw Jay Powell outline tapering in the November FOMC meeting. They're very clearly on a path to getting towards zero net purchases by the middle of next year, to give them some flexibility on the policy rates, immediately after in the second half of 2022. Does the Fed understand what you're discussing with respect to 1940s and 1950s? Or do you think we'll need to see another slowdown and another market event that would actually get them fully on board with maintaining this type of easy policy?
I think it's the latter. I think the Fed understands that it is playing an important role to keep funding costs down. And everyone can survive high debt stocks as long as the interest rate stays low, of course. But it won't be in a straight line, right? Basically nothing goes in a straight line. So the Fed will taper, and I think the market will be okay with it. Markets only react to changes in monetary policy if they come out of the blue. And I think the Fed is obviously smart enough to know that they need to float those trial balloons, see what the market reaction is. And if the markets are saying, yeah, fine, like if you look at nominal yields, you look at tips break evens, financial conditions. And so the market clearly is okay with that. And that's because we're in a strong part of the cycle. Your earnings are growing, 45% this year over last year. And so I think the Fed will be able to get away with this, for the lack of a better term. And then the hard part will be, how many times can they raise rates? Right now the Fed funds forward curve has 2 rate hikes in 2022, the back end of 2022. That's actually a little faster than the dot plot suggests. And then another 5 hikes after that over the subsequent 3 years or so. And at some point, that could invert the curve, and then everyone's going to have their favorite pastime of saying an inverted yield curve means recession. So I think we're a ways away from the Fed being in that kind of pickle where it needs to basically pick sides, inflation expectations versus economic conditions. But so my sense is that the path from here to full kind of control or financial repression will be a nonlinear one, where it will taper, then it will have to reverse the taper, then there'll be the next cycle, and then there'll be the cycle. But think about it, right? So we started this whole current era in 2008 with the financial crisis. Rates were 5% before then. Then they went to zero. We went to QE. And then we had several attempts to lift off that zero lower bound in 13. And then it finally worked in 16, 17. Then the Fed was deemed to go too far in 2018. And then we had that little 20% decline. It wasn't little, but it was short-lived. But here we are, 12, 13 years after the financial crisis, and we're still at zero, and the Fed is still buying bonds. And so to me, that's kind of the new era. And so it may be buying less bonds 6 months from now, and it may be raising rates a year or 2 years from now. But my guess is 5 years from now, we'll still be near zero, and the Fed will still play a large role. And just, one thing to keep in mind, the Fed's buying 120 billion a month. It's an enormous amount. The balance sheet is north of 8 trillion. That gets a lot of people very, very agitated or excited. But the Bank of Japan's balance sheet as a percentage of GDP is 131%. The Fed's balance sheet as a percentage of the U.S. GDP is 36%. And so even though the numbers are different, right? The Fed, obviously, the U.S. economy is obviously bigger, therefore GDP is bigger, the Fed's balance sheet is bigger. But if you think that the Fed is reaching the limits of what it can do, think again, because we're barely getting started over here.
I've learned that a long time ago, that there is no limit to any of this. We'll be dead before we figure out the limits. So let's just move on. And so in terms of, you made a few comments with respect to the longer term terminal Fed funds rate expectation sort of not being much higher than zero. And I tend to be in that camp. I don't believe we're going to get very much higher on the policy rate as a function of a lot of the debt that we see in the economy, and obviously the resulting impact of higher policy rates in terms of that debt stock. I tend to think that, clearly, if you look at the Eurodollar market, the over under on rate hikes for 2022 would probably be set at 1.5, right? If you're kind of, looking at that, or maybe even 2, because you're starting to get up towards, maybe 2.5 rate hikes in 2022, but it's somewhere between 1.5 and 2, the over under. I think the appropriate over under is probably half. And the reason I say that is because, when you go back and you sequence history, we've done a tremendous amount of work on relating impulses in the economy between growth, inflation, and ultimately the reaction function back to financial markets. And what we found is that, look, bond yields, policy rate expectations, all these things tend to go down when both growth and inflation are slowing simultaneously. And so, just looking at the balance of evidence across, many cycles and many decades on that point, I think we have to come up with something that's new and more importantly, more powerful, more pervasive than obviously back-tested history would suggest. I tend to lean on the camp of back-tested history and say, hey, whoever bond yields peak in this part of the cycle, this mini reflation cycle that we're observing here in Q4, it's likely downhill from there. It's likely downhill for policy rate expectations from there, because a year from December 31st, we're going to have growth significantly lower. We're going to have inflation significantly lower, and we're very likely to have a Federal Reserve that's having a very different conversation in the Equities building around that big circular table about inflation and about their need to do something about it than they are currently having now. Walk me through any sort of similarities in your view with respect to that, or any pushback that you might have on that view.
No, I think it's a great point, and the Fed obviously always has to balance the two mandates, right? In price stability, 2% inflation versus full employment, and we are getting to full employment. Like the unemployment gap that we had during the lockdown, the unemployment, the U3 unemployment rate, which of course is much less than the U6, but using the U3 for a moment. That unemployment rate minus what's considered full employment, formerly known as NAIRU, but now called the natural rate of unemployment, was 10, 11 percentage points. I mean, that's like, those are like Great Depression types of numbers. But because the analog has been and continues to be that it was more like a natural disaster, like a global earthquake or a global hurricane, it reversed fairly quickly. And that gap is now basically closed, or the output gap, potential GDP versus actual GDP is basically closed, or is about to close. And so the economic crisis basically has passed. And it's very encouraging to see that, we obviously are now on the back end of the Delta variant wave, right? It was a pretty massive wave in the US, certainly bigger than I was expected. Hospitalizations went from 2% to 14%, are now down to 6%. But the economy never closed down during that period, whereas during the third wave, the economy, really, really locked down. So my point is that economically speaking, I think we're out of the woods. Even if there was a fifth wave, the Delta Plus or whatever, it's not, we're done with locking down the economy. So we're back to full employment. We're beyond full employment. If you look at some of the labor statistics, like the quit rate and the JOLTS reports and the number of openings per number of job seekers. So I think from that perspective, the inflation pressures will tip the balance versus the full employment pressures. There's kind of that DEI lens in terms of who has the jobs, and maybe the Fed will look at U6 versus U3, which is still a sizable gap. But my sense is that the balance of the debate going forward will be more on the inflation side now that output gap has closed, and then it's just a question of what the Fed can do about it, and what the markets are doing about it, for the Fed, right? I mean, ultimately, this comes down to, not letting the markets run away with the narrative, right? So if the markets decide the Fed is committing a policy error by being too dovish, and inflation expectations are going to get unanchored, the Fed will have no choice but to step in, knowing, like we were saying before, that there's only so much they can do, right? So Jay Powell's not going to be able to channel Paul Volcker anytime soon, because the debt and demographic, background will not allow it. But they can talk a good game, and again, then it comes back to, like, if the market expects inflation to be the thing that moves the needle going forward, that should be reflected in the TIPS markets. But maybe that market is too repressed already by the Fed. So maybe instead we're seeing it in the commodities market, which of course are running, red hot right now. But ultimately there has to be a signal from somewhere. And so if the Fed is looking at the TIPS market saying, well, the bond market's okay with this, they don't see a problem. Real yields are still -1 on the 10-year, which is very, very low considering where we are in the business cycle. Normally, real rates are positive anyway, and they would be getting more positive, but they're actually staying very, very negative at this point. So I think the Fed will take its cues from the market, as it should do. I mean, the markets are not always right, but the markets are like the collective unconscious of all the money invested in the world. And I think there is a valid signal, especially in the U.S. where markets are very, very deep.
Yeah, no, I think I completely agree with you in terms of the Fed's likelihood to take their cues from the market. And that likely means, from my perspective, that we're going to get a very, very, I would say generational, because I would say generational went back to October 2018. I certainly remember some awkward meetings in Boston at that time, being bullish on bonds at that point. But in terms of the Fed taking its cues to the market, I think the market is going to lead them, in our opinion, to a path of incremental dovishness by the end of next year. They're going to go down this tapering path and then start talking about rate hikes, and I think that discussion, while the economy is decelerating, while both growth and inflation are decelerating, that discussion, that tightening discussion, that the angst that'll create amongst market participants is likely to catalyze a negative market event through the lens of the S&P or risk assets broadly, in our opinion.
I totally agree with that. Remember, we are, the economy has been booming as we come out of the lockdown. Earnings growth is already peaking at very high levels. So I'm not saying earnings are peaking, but the growth rate is peaking. So we are, as we get more from mid-cycle to late cycle and things start to slow down and people travel less because they actually have to go back to the office, who knows, but maybe not. But I agree with you that it's not appropriate to just extrapolate whatever we're seeing now, like for instance on the inflation front, and say we're going to have 5% CPI for the next 5 years. That there is nothing that kills inflation faster than a downturn in the economic cycle. So again, this example of stagflation in the 1970s. That's a very unique situation, and we can't just go to that as the default playbook because, like the middle 2000s, the late 80s, those were smaller inflation waves lasting, 5 years or so. I think those are more likely to be repeated. And if inflation goes from 2 to 3.5 on a 5-year CAGR basis, I don't, the Fed's not going to panic over that. They're going to talk a good hawkish game, and maybe they'll be incrementally more restrictive than they otherwise would be. But I think it's something that the Fed and the markets will live with, and ultimately, I think the demographics will rule there as well. You mentioned the percentage of population over 65. I have a chart of that, and it's this massive tsunami, right, of aging baby boomers. So the percentage of the population, the growth rate in the percentage of population over 65, it's this huge thing. It's going to keep going for another, 10 years until that 10-year rate of change starts to come down. And that line, that tsunami is perfectly correlated with, the valuation in the bond market. So the inverse of the bond yield, with the kind of like a PE of the bonds, that reached almost 200 last year, right? As bond yields went down to 0.5%. And so that seems to be the same thing, like the percentage of negative yielding debt around the world is following that same thing. And the equity Ps are following the same pattern as well, because if you're an aging baby boomer or a retiring baby boomer, you're solving for income, right? I mean, you don't want to be, invested in the NASDAQ 100 anymore if you're 65 or whatever. Maybe you are, but you want to get some income. And if you can't get that income from the bond market, and there's a bunch of large cap growth stocks in the equity market that are producing robust free cash flow and are returning the excess of that cash flow back to shareholders via share buybacks, that to me is the secular thesis, and why we're, I think, in a secular bull market for equities that is nowhere close to being over. And so I think, all the cyclical inflation talk that everyone is spending so much time on, and rightfully so, we have to keep in mind that there are pretty powerful deflationary forces out there as well.
I completely agree with you on those deflationary forces. You sort of hit on a few with respect to the labor market on the inflation side that I completely agree with you. You had cited the JOLTS data with respect to the job openings. Indeed has data out this week saying that it's up to 11 million now in terms of their calculations, which would be an all-time high. That's obviously driving a huge quit rate at 3.3%. That's an all-time high. And then you got the employment cost index at 3.7%. That's as high as we've seen in over 15, 16 years. But on the other side of that, with respect to the labor markets, I do believe, and I'm sure you would agree with this, you can sort of ring fence, I don't know what the appropriate number is, but you can ring fence, 70, 80%, 90% of the labor market and say that we are well past Nehru. This is an extremely tight labor market. But then there's that, additional 10% where you look around and it's really severely impacting the overall headline statistics. One thing I've been citing is the labor force participation rate for prime working age individuals. That's at 81.6%. That's down 140 basis points from where it was prior to COVID. That's a meaningful delta. And then you start to look at some of the compositional data within the labor market that the Fed is now focused on and training us all to focus on incrementally as it relates to the relaxation function, which is the unemployment rates across different cohorts, particularly ethnic cohorts. Obviously, the white unemployment rate is only up 120 basis points off its pre-crisis low. So we're pretty much close to full employment on that statistic. But then you look at the Hispanic and the African-American unemployment rates, they're up 240 basis points and 270 basis points respectively. So a lot bigger gap with respect to the degradation we've seen in those populations in the labor market. So that, in our opinion, until we get that part of the labor market fixed, that's going to be a major drag on the overall statistics. And once we get out of this very hot inflation sort of time period where the base effects are easy, the impulses are still really high, therefore you have very high inflation, therefore you have a lot of news articles about inflation. Once we get 6 months beyond that, and that's all in the rearview mirror, I do believe a lot of the sort of labor market slack that we're not talking about today will really start to come into fruition as the economy is decelerating, as the Fed's tightening into that deceleration.
Yeah, I agree. And if you slice up the U6 or the U3 by race, ethnicity, education level, there's very wide disparity, right? So the U3, which is the narrowest, but also, for instance, white college educated males. Let's use the most extreme example. They're well beyond